Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
Explotech Limited, which manufactures and supplies a comprehensive range of explosive and explosive accessories like slurry and explosives, detonating fuse, serving cement, mining, border road organizations use. The company has a pan-India presence and it keeps clients across 11 states and 2 union territories, along with exports to over 3 international markets. Its management profile is as follows. Their management has has a good experience in this field for multiple years. Their chairman is Mr. Navneet and his brother is whole-time director Mr. Sunil's son Rajan Somani is the executive director in the company. Some of the key facts regarding the business: they have 7+ years of experience in manufacturing explosive, and they have 3 group companies, 357+ clients with 40.68 lakh square feet area and 25+ years of experience, and they are present in 4+ countries with a total employee strength of 500+. Now, their sales breakdown is as follows. The numbers are not mentioned, so we are just going to refer to volumes. So regarding the sale of slurry explosives, it was around 34,000 million tons in 2024, which improved to 36,000 in 2025. Emulsion explosive improved from 7,000 million tons to 7,700 million tons in 2025. And sale of detonating fuse improved from 182 lakh meter to 345 lakh meter, which is a year-on-year increase of 88.92%. That's really good. And also they entered into the chemical space where they improved from 134 million ton to 3770 million ton in 2025 with a year-on-year growth of 2713%. So that's really good. And regarding the core competencies of the business, they have got industry leadership in the explosive segment, and they are constantly innovating and improving their quality to meet the highest client and regulatory expectations. Also, they're driven by sustainable innovation and they adhere to all the top tier safety standards. Regarding their product or service portfolio, as we had mentioned before, it involves slurry explosives, emulsion explosives, detonating fused, and cast boosters. Regarding the industry overview, the company believes that the India's industrial explosive market was valued at around $247 million in 2024, holding 23% of Asia Pacific share, and it is projected to go at a CAGR of 9%, and it would reach 1.4 billion USD by 2031, driven by growth in the mining sector, infrastructure development, and defense manufacturing sectors. So this is a huge industry tailwinds which would benefit this company. Regarding the investment highlights, the company has expanded by setting up a new state-of-art detonating fuse plant, and they're focusing on further capex. They're aiming at investment of approx 30 crore for expansion of emulsion explosives 3 and detonator plant as per the object of their IPO, which came in 2025. Also, they have done heavy capex in plant and machinery, factory building, and other assets. Their capital work in progress stands at around 7 crore 84 lakhs in second half of 2025. And they've also done investment worth 2.29 crore up to this year. They've got a strategic location advantage. They're located in Gujarat, which gives them a strategic location near one of the leading mining states. Also, the Maharashtra border is just 300 to 400 kilometer away, so giving them logistical advantage. And they are also strategically located MP within the radius of 100 kilometer, ensuring excellent connectivity and giving them access to key industrial region. All of this can reduce supply chain cost, provide wider access, and also reduce transportation costs and give them a strategic advantage in the growing and industrial sector. Some of the key ratios mentioned by the company as follows: the revenue from operations jumped by 15.17% year on year. The EBITDA went up by 9.17%, which is growth. Good. The PAT growth was 170% year on year, which is very high. So the company is claiming higher margins year on year. And the debt service ratio has also increased due to high margins. So the company tripled its net worth. It went up by 306% to 9,683 crores. Sorry, quadrupled, not tripled. And operating margin went up by 139%, and net margins went up by 122%, which is really good. And the current ratios has increased to 3.45 from 1.04 last year, which is good. Regarding their concentration, they have got their concentration in terms of procuring their materials around 71% of their come from the top five suppliers and 79% from top 10 suppliers. So that poses supply chain risk to the company. Regarding their customer concentration, its top 10 customers compose about 53% of their revenue from operations, which is not very high and not very concerning as well. They've got an order book of around 84.48 crores, with the PSU clients composing around 16.5%, retailer and dealers composing around 71%, exports contributing around 4.7%, and limited companies contributing to 7.7%. Now, the management has certain growth prospects in the upcoming years. They have planned for capacity expansion and product diversification. They've already set up a detonating fuse plant, which you already know, and they're further expanding to expand their product basket and also enter into other industry like the hydropower project industries and supply their explosives there. They're also planning on backward integration and trying to start the raw material production in house, which can give them an advantage because they are highly dependent on a few suppliers, and also they're planning on expanding the growth. Now, in the bull case, why it's exciting? So they have got industry growth drivers from multiple sectors, and they're aiming at investments further of around 30 crores. And they're currently focused on capacity expansion, product diversification, export growth, which we already mentioned. And they have got the strategic location advantage, high growth, and decent order book. Now, things which can go wrong with the company are as follows. Product manufacturer operated in highly regulated sectors. So any kind of regulation or tax or higher taxation can impact them severely. Also, few of the raw materials used and products manufactured are hazardous is in nature because they are explosives, which might lead to accidents. Also, they're dependent on a certain number of suppliers for raw materials, and they don't have any long-term agreements with them. And their business is primarily concentrated in Gujarat. Like 46% of the revenue comes from companies in Gujarat. So high concentration, and also they've got high promoter control and a significant amount of RPTs. In their 20 factors scorecard, they get a 5 out of 5 in IPO and fundraise history. They've done spend a lot of money on capex. Director and promoter track record is clean, but RPTs are too many, and too many RPTs involved unsecured loans to directors. If the company is growing at such good rate, why would the company give unsecured loans to directors? Because loans are around 4.5 crores, which composes around 2% of their revenue. So that's a bit concerning. So although they're paying the interest, but yeah, we need to monitor that. Also, I would mention another thing in the RPTs. So they have sold 23 crores worth of goods to a sister concern, which is a related party. That's fine. But they have 2.4 crore worth of purchase transaction with Rajan Enterprise and also 8.9 crores of sales transactions with them. Now, the problem with this is that Rajan Enterprise is not a subsidiary company. It is a partnership held by its two directors. So we need to look deeper into what the details of those businesses. Yeah, and regarding the board independence, they have only 33% independent directors and 50% family members on board. So I gave them a 3 year. CEO and KMP salary was low, so I gave them a 5 year. There hasn't been much resignations, only one due to personal reasons. So 5 year. There has been one auditor change that was before IPO, so give them a 5 year. Auditor opinion has been unmodified all throughout. There hasn't been any regulatory or legal issues against the company. And investor communications, all of them are there except the con call, so give them a 3 year. In their section 2, which is the financial analysis, they get 3 out of 5 in terms of business concentration risk because they're highly concentrated in Gujarat. Also, revenue growth by receivables is good, but it slowed down a bit as compared to the previous years. Operating cash flow as a percentage of EBITDA is very low, and so I rated it 0. This happened due to high inventory and loans and advances. Now, this loans and advances also include the loans and advances which the company gave to the directors. That's concerning that their operating cash flow is so low because the directors are taking huge loans from the company. Also, inventory trend looks good, so give them a 5 year, and cash conversion cycle is just 56 days, so give them a 5 year. Capex expenditure was 31.5 crores, and they spent 18 crores on repayment of borrowings and remaining for general corporate purposes. Their director track record is as follows. So, Miley family holds around 70% of the company, so high promoter control. They don't have any red flags against them, so give them a 5 year. Regarding the related party transactions, the directors had taken loans worth 1 crore in 2024, and they have unsecured loan balance of 4.3 crores standing in fiscal year 2025 according to their RHP. They're paying interest, but they're draining the company's growth potential. Also, they have 23 crore worth of goods sold to the sister concern, which is a subsidiary company, and they have 2.4 crores worth of purchase transactions with Rajan Enterprise, which is a partnership privately held by its directors. And they've also got 8.9 crores sales transactions with them. Regarding their board independence, they have 6 directors, out of which 2 are independent and 3 are family on board. So gave them a 3 year. Now, CEO and key managerial personnel salary, it has decreased according to the RHP. It's 12 lakhs and 6 lakhs for both of them. But however, in their 2024 annual report, they did not mention specifically, but they said that 44 lakhs were paid as salary to key managerial personnel, and there were only 2 key managerial personnel. So I divided it by 2. So that means it has decreased a bit. Also, company secretary resigned in 2025 on account of personal reasons, so give them a 5 year, nothing very concerning. Statutory auditor resigned in 2024. It may be due to because of they might be disqualified managed listed companies. That might be the reason, so give them a 5 year. Auditor opinion has been unmodified all throughout, so give them a 5 year. Regarding regulatory and legal issue, nothing could be found. And investor communication and disclosures, they do the presentation and press releases. They do the results half yearly, and they don't do con call. So give them a 3 year. So regarding their business concentration risk, state-wise revenue breakup comes as this: Gujarat contributes around 47% of the revenue, Rajasthan 15%, Maharashtra 10%, Haryana and Madhya Pradesh sums up to around 17%. So that's highly concentrated in Gujarat. So give them a 3 year. Revenue growth as a percentage of receivables is low and it has been decreasing, but revenue growth has cooled down a bit. They did minus 18% in fiscal year 2024. We don't know the exact reason for this, but yeah, but receivable growth has been a bit lesser as compared to the revenue growth, and it has been decreasing, which is a good sign. So give them a 5 year. Operating cash flows by EBITDA is just 18% and it was 10% last year. This happened because they have very high inventory and loans and advances. These loans and advances also include the loans and advances the company paid to its directors. So give them a zero here. So inventory trends are good. DSO is low. Inventory days is not very high. So give them a 5 year. Cash conversion cycle is just 56 days, which is very good. But it has been increasing in the past 4 years. And capex as a percentage of revenue is 3%. Fixed asset turnover is good. Asset turnover is good. And return on invested capital is around 25%, which is very good. So give them a 5 year. Debt to equity ratio is 0.2, which is a good sign. Interest coverage is 6, so give them a 5 year. Quick ratio and current ratio have improved significantly since last year, so that's good. Give them a 5 year. Return on equity, return on capital employed, and return on asset metrics all are good and growing numbers, so give them a 5 year. Growth consistency is also good apart from this minus 18% revenue thing. However, the company has been growing its PAT very nicely over the past few years. So they're expanding their margin. So that's a good sign. So overall, the score comes up to 87, 41 from governance and promoter behavior, and 46 from financial health.
So the current PE is 25.6. I really like the industry the company is in. My only issue is the related party transaction, as you mentioned. It is quite significant. And if you see, we are also making
paying interest. See, still the company's cost of capital is still increasing. It's doing good return on equity and invested capital. So why would they give them interest? Like, it makes no sense.
Yeah. That is one. Second, even they didn't, the more important thing is they did an acquisition of Aswara Industries. This again falls under related party transaction promoter controlled.
Yeah, Aswara is subsidiaries.
Yeah, so again, promoter control, they did an acquisition. They're buying 100% stake, which is good, but then the related party transaction part is something which needs monitoring in this case. Otherwise, the industry they are in is very high moat industries because they are into explosive and it is not easy to set up a plant, get the required license. They're also planning to enter defense, so getting a license for defense would also take time. Like anyone who wants to get into the defense sector for explosives would require at least 5 to 6 years to get the necessary licenses. So very high moat industry. It's a new listing. So I listened to one of the con calls before their listing. So anyway, if you're giving it a PE of 20, it is the fair value for the next year target price would come to 286. It's already trading at 240. And also considering the fact that they do almost 40% jump in revenue, which is a bit of a stretch according to me. 247 is still conservative, and if they do the same 10% margin, then at a 20 PE, it comes to 262. So I'm giving a higher margin, so we are getting a higher EPS. So almost at the current price reflects there's limited room for upside for at least if you're having a 1 year perspective. So let's take a longer time frame. Like they did a net profit of 12. You can take net profit or profit before tax, but to be conservative here, and minimum discount rate of the required return of 20% and terminal growth rate of 3. And if we are having 5 years of time horizon, and at the end of the 5 years, a conservative terminal PE of 15, it means the company has to grow at least 27% to realize that. So a lot of things
the company come down to 15 PE. 15, isn't it too less?
After 5 years, I'm saying.
Yeah.
I am after 5 years, what is the terminal multiple is what we need to put. So it's always better to be conservative here. Currently, we are at a high PE environment. I'm not sure about the PE multiple, if that is going to be compression or not. So better to be conservative. So considering the PE would be around 15. If you're going to put 20, which is the current PE, then obviously the implied growth rate will come down. So it has to grow only 20%. So it's a 5% reduction in P. You could see the difference that is happening over here. So better be conservative when you're doing this. And this is not very foolproof as well. And there are a lot of assumption going into it. So better take a conservative value to see whether the valuations make sense at the current juncture.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.